In today's video, we're going to talk about how you can supercharge your Roth conversion with a reverse mortgage. Hey folks, I'm Dave McKnight, best-selling author of The Power of Zero. The number one reason why people don't execute a Roth conversion is because they don't want to pay the tax on their IRAs until the IRS absolutely requires it. In today's episode, I interviewed Don Graves of the Housing Wealth Institute, where he explains how to utilize a reverse mortgage to help pay the tax on your Roth conversion so that you can eliminate any misgivings around that tax payment and supercharge your tax-free retirement plan. Don Graves, welcome to the Power of Zero show.
Oh, thank you, Dave McKnight. Fantastic to be here.
Yeah, I'm sort of a late convert to the reverse mortgage discussion. I, like many people, have been skeptical about reverse mortgages, and of course, a lot of that is due to, back in the day, I think it did have some. It wasn't as mainstream as it was now, and it's not as it wasn't seen as a safe alternative back in the day, and you had various celebrities that were hawking it, and it just seems like reverse mortgages have really come a long way. And I'm actually a late convert, and I'm totally on the bandwagon. But we're bringing you on today because you are one of the foremost experts in the nation on reverse mortgages, and we want to get it right from the horse's mouth. So let's just start off, Don. Why would any of my listeners be compelled to use a reverse mortgage as part of a retirement plan? What does it have to do with retirement planning?
Sure. And thank you, David. And reverse mortgages, I've been doing this. I'm coming into my 23rd year. And so I've spoken to a lot of folks, and there's just there's history with anything that's 23 years old has evolved and grown and developed. And I understand a lot of the concepts need updating, I would say, kind of like your first cell phone to what you have today, the smartphone. But why would anyone be wanting to consider a reverse mortgage? I would say this. A reverse mortgage is really just a financial planning tool cleverly disguised as a mortgage. It doesn't really resemble a 30-year mortgage or a home equity loan or line of credit, and I'll share that in a moment. But when you learn to use it correctly, I thought about the football. I'm a big football watcher, and I thought about the team in the Super Bowl that went out on the field, took the offense with 10 men, and they defeated the team with 11 people to win the Super Bowl. And someone said, wait a minute, Don, that never happened. I said, you're absolutely right. It never happened because there would never be a professional football team that would take the field with 10 men. And I said, but financial advisors do that all the time. You have your clients' income, Social Security, pension, maybe employment. You've got their investments. You have their insurances, fixed and variable annuity, whole and term life, long-term care. But the 11th man is housing wealth. 87% of retirees have housing wealth. It's $6 trillion in unmonetized senior housing wealth. And the question is, would you ever take the field on offense to win the Super Bowl with just 10 players? No, you wouldn't do it. The 11th man, it doesn't ensure you're going to win, but it certainly gives you the advantage. So why reverse mortgages? Because they're not new, 1961. They're not spooky, insured by the federal government in 1988. And they're profoundly useful if we want to win the financial championship, very much like the work you've done with life insurance, David, and helping people to get out of that. Even me, saying, well, life insurance is for death. It pays the death benefit. And folks like you said, no, Don, it's for life and it's for living and for today. So reverse mortgages fit into that kind of framework as the 11th man.
I love that. I love that analogy. And I think that somebody somewhere along the line explained this to me, and I really had a light bulb epiphany type moment. And what they basically said was, they said, only 1% of children want to inherit their parents' home. And if they do inherit it, what they typically do is they want to liquidate it so badly that they sell it on a fire sale. So they sell it for pennies on the dollar just because they want to liquidate it so quickly and get their hands on the money. And what they would much rather inherit is actual wealth, stocks, bonds, mutual funds, things that are a little bit more liquid. And so the way it was explained to me was, you said, instead of having your children inherit your house, something that's very illiquid that they would have to liquidate probably on a fire sale to be able to access, why not live on the equity of your house while you're alive, allow your stocks, bonds, mutual funds, so on and so forth, to grow and compound over time instead of liquidating those. And then when you die, you've sort of spent all of the equity in your house, or at least most of it, and all of those other assets remain not only untouched, but they've grown and compounded over that time period. And so that's what the children inherit versus inheriting an illiquid house. And that, when I had it explained to me in that way, I really did have a light bulb moment. So Don, if you could explain to our listeners, with my listeners and people who read my book, that they want to know how a reverse mortgage can fit into a retirement income plan that helps put them in the 0% tax bracket. I have people that come up to me all the time at conferences and symposia, and they say, Dave, why don't you talk about reverse mortgages in your book, The Power of Zero? Because those are tax-free. Explain to people why reverse mortgages should be considered a tax-free stream of income, right along with Roth IRAs, Roth 401ks, Roth conversions, LIRP, so on and so forth.
Sure. I'm going to share my screen and just give a quick case study.
That's great.
David, and just for your listeners to see. And
for those of you who are listening on the podcast, this would be a great time to go over to YouTube to see all of the visuals that Don is now displaying on the screen.
So Bob and Sally here on the screen are your typical retirement do-it-yourselfers. And by do-it-yourselfers, I mean that 86% of baby boomers, so says American College, they don't have a written retirement income plan or anyone they consider an advisor. So they're 65, they're preparing for retirement. They've got 500,000 all in IRA and 401ks, which is typical. They have a home. 87% of retirees have a home, and they have no mortgage. And so with a reverse mortgage, the amount of money they are able to get is based off the age of the youngest borrower, the value of the home, and the interest rates. So $224,000 is now what Bob and Sally are looking at. Now, here's the fascinating thing. The reverse mortgage line of credit. And people say, I've never had a line of credit. I said, sure you have. You've had a Visa, MasterCard, Discover. That's a form of a line of credit. Of course you've had that. And I said, so the reverse mortgage is just like a HELOC, a home equity line of credit, but it's a RELOC, the retiree's line of credit. Now, here's what's different. And here's how it's going to fit in to a planning perspective, that the reverse mortgage line of credit, and this is what got FINRA, the Financial Regulatory Authority, to change their official position on reverse mortgages from being it should be used only as a last resort to it should be incorporated into a reasonable and responsible retirement income plan. The line of credit for the reverse mortgage is growing. It's non-cancelable. People discovered in 2008 that their line of credit at their bank could be frozen, capped, canceled, or reduced. It's bi-directional. Take money out, put money back. It's non-impactful. That if you take money out, you're not required to make a monthly payment. Insured, here's the part. It's non-provisional. That the dollars that come out are proceeds from a loan, therefore they're not taxable and they're not tied to the home's value. So I want to look at a simple chart, and we'll base all of our kind of conversations off of this. So here's Bob and Sally. Column A says they've got a reverse mortgage of $224,000. Watch this. The unused portion of that reverse mortgage 10 years later is $351, $550, $720. Then here we are, 30 years later, $861,000. So the first thing is the unused portion of reverse mortgage is a growing line of credit, It can be taken out as cash. And this is where David and we kind of got together. And I'll go back to that chart in a moment. But someone had introduced me to your book, The Power of Zero. And I was speaking for Ed Slott conference. And they said, read this before you get here. And I was blown away I mean, I was up at nighttime like Jake from State Farm, and my wife says, "What are you doing?" I said, "I'm with Dave McKnight." Who is this person? And I'm just highlighting, and it was amazing. To me, it was like the reverse mortgage. It was the secret that many people didn't know. And I kept saying, "Why don't people know this? Why don't people know this?" And you had a wonderful case study on page 81. And I said, "Oh boy, if David had this." And I understand. I want people to stay in their lane. See, my lane is reverse mortgages, so I'm not writing books about life insurance or annuities. I write about, so I understand that. But I said, oh, if David's advisors knew that there was another source of tax-free income, I thought they could expand their pool of eligible um, consumers or clients, and they can do more. Let me go back to the screen. And David, interrupt when you went. So over here, this is what I showed at that Ed Slot event, this right here. And I said, all of these dollars, everything in here comes out tax-free. So if a client is going to spend one nickel more and blow up their tax bucket, maybe they were trying to get from 24 to 22, 22 to 12, 12 to 10, 10 to 0. But anytime they spend a nickel more from the wrong source of income, they're going to blow it up. I said, wouldn't it be wonderful if they knew, and 87% of retirees can do this, if they knew there was something that looked like that chart right here, that they're sitting on, a source of tax-free income that could help them go from 24 to 22, 22 to 12, 12 to 10, 10 to 0, because they don't have to take extra money. They've got more to work with. I said, wouldn't it be great if they knew that? And then there are other things they could do. So that's just kind of one idea of how do we use this for tax bracket management, just by giving folks another source to draw from versus their provisional income that keeps it in a lower bucket. Another thing that happens, the most fascinating, is Bob and Sally have $224,000, but they had a mortgage on their property. We'll call these couple Pierce and Linda. And let's say their mortgage was $200,000. So the first thing the reverse mortgage would do, the 224, it pays that off. Now, this is going to do some pretty fascinating things. If you pay off a mortgage, let's say they're paying, I don't know, $2,000 a month, principal and interest on that mortgage. And I asked them, how much do you save when you eliminate a monthly mortgage payment? They said $2,000 a month. I said, no, it all depends if you're taking money out of your qualified plan, and they happen to be. So I said, that's $2,500. You have to take out to net $2,000. So if we can save that, I said, we've saved $30,000 a year from coming out of your provisional income. And I said, that's certainly lower taxes, but that could even be a whole different tax bracket if you do it well. They hadn't thought of that. And the last thing I'll say is something I really learned from you, David, when you did your YouTube on Social Security being taxed. As much as I've read it and seen it, but watching you do that illustration on your YouTube channel, the lights went off. I finally understood that people who are taking too much provisional income get their Social Security tax, and to fill the gap, you said they take more money out of their IRA and provisional income, and that causes them to run out of money sooner. If you can stop getting your Social Security tax, I think you said 5 to 7 years more. And I thought, oh gosh, here it is again. And so instead of, if your Social Security gets taxed, instead of taking it out of your IRA or your qualified plans, which creates a bigger hole, take it out of this. I said, if we did just that one thing that 87% can do, we've just saved people 5 to 7 years, but they didn't know that. They didn't know that. And so I get excited, too excited. It's like my Martin Luther King, I Have a Dream speech. I get too excited about all the ways that we may be missing ways to help our clients. And that's why, again, I'm so excited about being on here with you. Let me stop here.
Yeah. So, so just to summarize for my listeners, they'll know from all my other videos and my books that we are only really interested in true tax-free investments, and true tax-free investments have two qualifications. Number one, when you withdraw money, you don't pay any sort of tax. You don't pay state tax. You don't pay federal tax. You don't pay capital gains tax. And number two, when you take distributions, it should not count as provisional income, which you've already mentioned, which is the income the IRS tracks to determine if they are going to tax your Social Security. And as you rightly stated, if your income, provisional income gets too high, you're going to have to spend down all of your, in your Social Security, it's taxed. You have to spend down all your other assets to compensate. And that could force you to spend down that 401k and then IRA and run out of money 5 to 7 years faster than you otherwise would have. And so, Don, correct me if I'm wrong, but what you're saying is that when you take income by way of that reverse mortgage, it is a true tax-free stream of income. It does not get taxed in any scenario. And when you take that income, it does not count as provisional income and therefore does not count against thresholds which cause Social Security taxation. Have I summarized that correctly?
You have summarized it correctly. Now, every now and again, people will fight and say, well, it's not income, Dave. It's not income. It's proceeds from a loan.
Right.
I said, well, okay. And Dr. Wade and Fowl and I've been on the same side with this. Well, what do you call it when you get money from somewhere and it goes into your bank account? Well, it's income, but it has to be paid back. And so the analysis is, if I can get you in a lower tax bracket, this becomes negligible at best, as we're preserving taxes. And I'm of the persuasion that we're going to see them go up. And I think in some measure, David, correct me if I'm wrong, they're already going up. And in some form, maybe not in the income tax form, but more money is leaving our pockets than there were 3-4 years ago. And that's going to continue, I think.
So one of the things that we see from our clients and our advisors is there's a real roadblock in getting our clients to reposition money from tax deferred to tax free, particularly when it comes to like a Roth conversion or an LIRP conversion, where you're shifting money from an IRA either to a Roth IRA or to an LIRP. Mm-hmm. And so paying that tax before the IRS, requires it of them, paying it preemptively, if you will, is a huge source of heartburn, and it prevents some people from ever entering into the transaction. It prevents people from ever wanting to shift money to tax-free to protect their assets from the impact of higher taxes. Can you talk a little bit about how a reverse mortgage could help grease the skids in that whole shifting process?
Sure. And for those who are listening, I want to go back and you're well read, but sometimes Don, what is a reverse mortgage? And I just don't want to take anything for granted. And I used to say it's a good way to get killed at a barbecue. I don't say that anymore, but I would say, you ever mention reverse mortgage at the family get together? What happened? 3 people fainted at the table, 3 people left, and your Aunt Janie made a shank out of a plastic knife and fork and came after you. I said, it's just dangerous to mention reverse mortgages. But in simplest terms, IJAM, it's just a mortgage. It's just a mortgage. It's a home equity loan for retirees age 62 or better. Now, there's some for age 55 these days, but allows them to convert a portion of their home's value, turn it into tax-free dollars without giving up ownership of the home, required to make a monthly payment or come off title. It's a way to access your home equity without impacting your cash flow. So when we talk about, I'm going to share my screen. And David, you again, I've been your student way before we were friends like this. And part of that is I just consumed your content. And once I learned about it, I consumed about it. And one of the things I talk about is a reverse mortgage retirement plan, which is not using reverse mortgage independently of your income, investments, and insurances, but using them in a collaborative way and an integrated way to produce the greatest outcome. Because what's been proved now by the math and science and the research, Texas Tech, Ohio State, Cambridge, MIT, who's up there? Oh my gosh, he won the Nobel Prize for economics. His name escapes me. And but it's been proven that to incorporate housing wealth in the conversation leads to better outcomes than not incorporating it, whether you do it or not. And here's such an example. Now, here's a client, and $1 million in a qualified fund, and they're concerned, boy, taxes are going up. We want to get it out of the qualified funds. So we've got $1 million over here. And we say, well, how do you do it? Well, I can just convert all million, but I'm going to pay taxes. It's going to blow up my tax bracket. So let's do it in a structured way, structured Roth conversion. And in this example, I said, let's consult your tax advisor. But what if you converted $100,000 a year? Now you need to pay the taxes on that. So what we're going to use the reverse mortgage line of credit 224, and it's a growing line of credit. So it grew by $10,000 that year.
How does that grow, by the way?
It's baked into the program in 1988. So when HUD, FHA developed a program, that's a great question. And Don, how does the line of credit grow? It's not magic. It's not based off the home's value. It's baked into the program. The philosophy is, if you go get a traditional home equity line of credit of $200,000 at your bank, and you don't use it, 10 years later, it's still $200,000. It did not keep pace with inflation or any other thing. So when HUD developed the home equity conversion mortgage, the federal version, they said, we're going to allow the line of credit to grow at exactly whatever the interest. So it's designed to kind of be a buffer against inflation. So here's a 224 line of credit, and it's growing. It's always growing. You can't make it not grow. So it's grown, but the taxes, we're going to do a Roth conversion that year of 100,000. So instead of paying the taxes on the asset, we take out $24,000 of this growth. And then the following year, the reverse mortgage line of credit balance was 210. It grew. We took some money out to do the Roth conversion, and we keep doing that. And then 10 years later, we've converted $1 million. We paid the taxes with the reverse mortgage, and we still have access to the line of credit to do tax bracket management, volatility buffer. We've got some of the other things, but we just simply use the growth of the reverse mortgage line of credit to pay the taxes, or part of the taxes, on the Roth conversion, so you don't cannibalize the assets. So instead of ending up with $780,000, and you convert the whole $1 million, and you still have this other asset to do. And if you start early enough, at age 62, by the time RMDs would have been required, it's all out of there. And so that becomes, and I want to say that sometimes I talk David, and they say, oh man, you're a hammer, and to you everything's a nail. I said, no, I've got 23 years of moving people from net negative to trying to get them to neutral on this reverse mortgage deal. No, I don't believe that's the conclusion to every problem, but I do believe it's the conversation that's worth having to any homeowner who has a home. There are 42 named strategies that we can use, 42. And anybody who's retiring and has a home, I'm able to work with the advisor, because that's what I do. And I work with financial advisors. I've done so for 23 years. I was privileged to create content for the American College and the RICP, the first one to do that around reverse mortgages. And I've just been extremely blessed to do what I do.
You know, the thing that's fascinating about this is if you think about doing a Roth conversion, you convert 100,000, let's use your example, you convert 100,000 per year from your tax deferred bucket to your tax free bucket. Okay. Mm-hmm. If you pay the tax, and you got to be over age 59 and a half to even do this, but if you pay the tax out of the IRA itself, you're going to end up with less money in your tax free bucket. So you're going to have less money going to work for you in the tax-free bucket. So I'll give you an example. I have the IRS withhold tax, let's call it 30% from my IRA in the Roth conversion. That means 70,000 makes it over into the tax-free bucket. So I now only have 70,000 instead of the full 100,000 that I'm taking out of that, that's making it over into the tax-free bucket. If instead I pay that tax out of the home equity line of credit, then the full $100,000 is going to make it over into the tax-free bucket. So instead of having 70,000 go to work for me, I have 100,000 go to work for me, and I'm less likely to bump up into a higher tax bracket along the way. So it's just having that pot, tax-free money, gives you options that you don't otherwise have. And that's another compelling part of all of this, is that we're trying to, if you envision the three buckets, we're trying to get money flowing from the left buckets to the right buckets. We want money flowing from left to right, from taxable and tax deferred to tax free. The question always becomes, how do you manage the tax? And if you have a pool of tax free dollars that maybe wouldn't have otherwise been available to you, you now have a catalyst, if you will, that helps propel that money over to the tax free bucket in a much less painful way. So people are less likely to balk at the notion of shifting money to tax free, because they have a pool of assets that's tax free that is much less painful to access than just paying that tax directly to the IRS.
Absolutely, David. That's a worthy conversation that your viewers and listeners can have who are in the retirement planning space, or even if they're consumers. 87% of retirees own a home. The first case study I gave, more than 68% of retirees are coming into retirement with either a mortgage, a second mortgage, a home equity loan, or a home equity line of credit. Being able to strategically have a conversation about what does it mean if we can eliminate that, particularly if you're beginning to draw down, that opens up significant doors of planning conversations and opportunities. One of the things people don't know, one of my favorite questions to train advisors, I said, you're sitting in front of a client. You're structuring some life insurance. You're doing the zero tax bracket planning, but they've got a mortgage on their property. And I know just from what I do, there are 10 things, 10 planning conversations, but here's a simple one. You look at Mr. and Mrs. Jones, say, Mr. and Mrs. Jones, I see that you're already, that's my word, I love it, you're already making a monthly mortgage payment. You can't stop, I can't stop. And you say to them, I'm curious, if you had a choice, would you rather that payment be mandatory or voluntary? What would you choose? They look back and, duh, Don, voluntary. I said, me too. Why would you choose voluntary? And they're going to tell you freedom, flexibility, control, give more, sleep better, spend less, make my savings last long. Absolutely. So, Mr. and Mrs. Jones, if we could take your mandatory payment, make it a voluntary one, would you want to see how it works? And that question alone, that I should have developed 23 years ago, but I developed it 3 years ago after an event I did with your buddy Ed Slott, has led more advisors to have significant conversations. Because if I'm not paying $2,500 a month, what does that mean for my life insurance retirement plan? Can I use those dollars to buy more? Can I use those dollars when I get into retirement to keep the payment going? That happened a lot at the beginning of the pandemic. Hey, gosh, the things have gone south. I want to keep making my premium payments and I don't have enough in there for it to self-fund yet. What can I do? Well, there are 10 conversations that have impact for the zero retirement planning person, your group, and the consumer that says, I know that 68 to 88% of retirees are carrying some sort of loan payment into retirement. We can eliminate that, or at least at minimum, take it from a mandatory payment to a voluntary one. What conversations open up? And I promise you that most people listening would say, there's a voluntary payment available for mortgages? And that's a revelation to them right now. And I say, yep, there is.
Well, Don, in closing, can you, if somebody's listening here and they're saying, I wonder if I'm a candidate for a reverse mortgage. So just in closing, would you mind sort of describing the profile of the typical person for whom this strategy might apply?
Sure. My typical client has somewhere between 250,000 in savings and 2.5 million. And so they're not poor, they're not destitute, they're not rubbing two nickels together to start a fire so they can have their last meal. But they believe in insurance, which is they believe in planning for the what ifs in retirement. So they have insurance for their life, they have insurance for their car, insurance for their home. But do they have retirement income insurance? So the client that really, I think, fits well with the reverse mortgage is those that are proactive thinking and understand the future is anything but certain. Market volatility, longevity of life, future tax rates, healthcare cost, inflation. Who thought inflation would be 8%, 13% in Phoenix? No one thought that. So the person that says, you know what? I don't want to take the field in the Super Bowl with 10 men on offense for my team. I want all the available players on the field at all times to give me the best opportunity to win the championship. That type of thinking is the client that says, I understand reverse mortgages are just a tool to fit in with the other tools, but they give me an opportunity to win the championship. So age 62 or better, you own a home. You've got typically 50% equity in the house. A housing wealth assessment, I think, is a valuable resource for you. About 20 minutes. We do them all day long. I've got a team of people that do them. That's valuable because at least you know what you're sitting on. And David, I made a mistake here. I was in the basement of a church one time, and I was talking about this, and I said to pastor's wife, and I said, like you, Mrs. Jones, I said, you've got a big asset. And then the deacons immediately came and escorted me out of the business. But we've got a big asset that we're sitting on. How do we use it in conjunction with these other things, particularly life insurance, to create a sustainable plan with the inevitability and uncertainty of change that's ahead of us?
Outstanding. And Dawn, for my listeners, if they want to learn more, I know she got a couple of books back there. Do you have a website? What's the best way for them to learn more about you and what you do?
Sure. You can www.housingwealth.net get you to my website. You can contact me through that, and or you can just always email me, askdongraves@gmail.com. Either of those will get you to me. And but thank you, David. It's been a pleasure.
Outstanding. Well, Don, I appreciate your time. I appreciate your expertise. Your reputation precedes you. I've had a lot of people come up to me and say, "Have you ever heard Don Graves speak?" And I said, not live, but I've had lots of conversations with him. So this has been really, really useful. It's been an honor, and I really appreciate you being on the Powers Your show.
Thank you, David.
Okay, folks, that was my interview with Don Graves of the Housing Wealth Institute. If you need some help setting your tax-free retirement plan in motion, head on over to davidmcknight.com. I'm happy to lend a hand. And if you have any comments or questions, feel free to drop them into the comment section below. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.